What's going on, guys? Welcome back to another video with Think Like a Jew here, and today we're going to be talking about something that I've been itching to talk about, but I had to wait for the right opportunity to do so. And if you take a quick glance at my TikTok, you already know what we're talking about today. Everybody's favorite brick and mortar game retailer, GameStop. Now, before you think this is some sort of stock market conspiracy theory run by some random teen on the internet, just listen with an open mind, because I can provide some facts and information that may change the way you look at the stock. Because although mainstream media and market experts have been telling everybody that this is a dead stock, a lot of analysis has gone into this from a lot of smart people on Reddit that says otherwise. Now, I'm not gonna sit here and tell you to buy GameStop stock because it's going to the moon. No, because if you just listen to my opinion and you just went and bought a stock without looking at the analytics, metrics, or numbers behind it, then you're just a sheep. What I am going to do, however, is use real-world information that is publicly available to prove to you that mainstream media and the hedge funds are lying to you. Now, before I explain the whole GameStop situation, I first have to go over a few terms that some people might not know about the stock market. So if you know how hedge funds works, shorting works, and a short squeeze works, skip to the time posted right here in the video. Now, unless you've been living under a rock, you've probably heard something about the hysteria that was the GameStop short squeeze. But what exactly is a short squeeze? Well, that's a really rare occurrence in the stock market that sends a price flying, but to understand how it really works, first you have to understand how shorting a stock works. There are two main positions that you could take in the stock market, a long position and a short position. Now, a long is something you're probably already accustomed with an individual buying a share of a company, holding it, and then hoping that the price goes up in the future so they could sell it for a profit. A short position is basically the inverse of a long position, where instead of buying off the open market, you just go to a lender who already owns the stock, says, hey man, let me borrow that stock and later down the line, I'll return the stock plus some interest. Then they take that borrowed stock, sell it on the market, and then pray that the stock price drops so they could buy back the stock, return it to the lender, and then profit the difference all tax-free. A short squeeze occurs when the price of a stock is in a very high range for a long amount of time, so that shorts begin to close their positions, further boosting that stock price up. This is because shorts have to pay interest on their positions, so holding it for an extremely long amount of time when you're already in the red does not make much financial sense. So when they no longer feel like paying that interest, they'll just close the position at a loss, which is essentially buying the stock at market price, because remember, they have to return the share that they borrowed back to the lender. So when they buy it on the open market, it further drives up the price. Now this rise in price due to the shorts covering actually creates more shorts covering. So it's almost like a chain reaction to the point where the graph starts to go straight up. Let's say somebody chooses not to close their position when they're already very far in the red. What a company can do, the lender of the stock, they could actually call you up on a margin call and say, hey man, I need that stock back. And it forces you to buy that stock at market price and return it directly back to the lender. Now, to people like you and me who have fairly average amounts of capital, this system of long and short positions seems extremely fair. You don't really see where it can be taken advantage of. But to people who have lots of capital and not many people to answer to, they can easily take advantage of it. Now in come hedge funds, one of the grimiest players in the stock market. Hedge funds, if you don't know, are massive groups of capital that are controlled by an extremely small group of managers. The problem with this is they can literally manipulate the markets however they want, sparking massive up or down swings depending on what they want because of the sheer amount of long calls and short puts that they can create. However, simply moving the market up and down doesn't actually profit the hedge funds because their money is the one moving the market, so they haven't profited off of it yet. No, their profit comes to the people who get scared when they see a massive drop and who get FOMO when they see a massive rise. That is how they make their money. For example, let's say a hedge fund shorted a company massively. That would tank the stock price, at least for a little bit of time. Now keep in mind, hedges have not profited yet, even though the stock price has dropped significantly because they were the ones who caused that change. What actually has them profiting is when all of the investors in the company see the massive drop, get scared, and then continue to sell off, which basically boosts that downtrend, and that is how the hedge funds make money. They capitalize on your fear. Not only do these hedge funds short in massive amounts, but they short so much to the point where it's literally illegal. This practice is called naked shorting, and it means that there are more short positions than there are shares that you are able to short. Now, this should be completely impossible because to short a stock, you have to borrow it from a lender and then sell it on the market. So for there to be more short positions than actual shares means that some shady dealings were going on. But anything can happen when a hedge fund is involved. And they're able to hide these massive illegal short positions with synthetic calls and married puts, which basically uses their massive amount of capital to just hide their short position. Not only can they easily hide their positions, but they don't have any regulation on what they report. So they could basically lie to you about what they own and what they don't, and the fines that they would receive are so small that they're basically negligible to the profit that they made by lying to you. This literally incentivizes illegal trading and is a recipe for disaster. Not only can they lie on the numbers that they produce, but these numbers are completely self-reported. Nobody checks them, nobody oversees them. It's basically whatever they want the public to know, they tell the public. Whatever they don't want the public to know, they keep secret. And if they don't want the public to know something, you're not going to know about it. With such power over the markets, one would expect that there would be plenty of regulation to keep them in check, but if you were alive in 2008, you know that's not the case. As of recent, hedge funds have targeted their shorting at brick and mortar retailers. Basically, their idea is that the future is online sales and any brick and mortar company is going to become irrelevant, causing them to go into bankruptcy. One of the most prominent examples of this, which you probably know about, is Toys R Us, which went bankrupt a few years back. What you may not know, however, is that Toys R Us was the victim of a hedge fund short ladder attack, which actually helped contribute to their bankruptcy. Now, this strategy was able to work so well because at the time, Toys R Us was struggling to get into online retailing, which was at the time viewed as the future. Their inability to get into the online market already made Toys R Us investors a little bit scared, and when the shorts started attacking and the price started to drop, that was their incentive to sell. Now, this made hedge funds a lot of money because Toys R Us ended up going bankrupt, but what they also did was steal away an important part of mine and a lot of other kids' childhoods. Ha, now it gets fun. In comes GameStop. Just like Toys R Us, GameStop was a brick and mortar retailer that's future looked like it was starting to dim. And that's when massive market maker and hedge fund Citadel jumped in and took a massive short position on the company. Now, Citadel isn't a normal hedge fund. They're actually what's called a market maker, which are people that allow liquidity in the market, and they're able to bend some of the rules, which is why they're able to use some quasi-legal methods to actually legally naked short. In simpler terms, they're basically the brokerage's broker. And want to know who relies on Citadel to be their market maker? Robinhood. But we'll get to them later, don't worry. But I mean, why not let the hedge fund that's literally banned in certain countries from shorting to have all this power in our market? I mean, the SEC literally says that naked shorting can take down whole markets. After Citadel took out their large short position, GameStop's short interest was 140%, which meant there was more short positions than there were shares in the float, which is the publicly traded shares. How is this possible? There are literally more short positions than there were shares to short. It makes no sense. Now, in around February, a man named Deep Fucking Value took to the subreddit wallstreetbets and posted his position and his due diligence on why he took his position. He bought a long call with an insane strike price and put in around $40,000 of his own money. After explaining his position and showing how unfairly the company was shorted relative to the amount of income they were pulling in, the subreddit filled with apes and degenerates took off, buying up as many stocks of GameStop as they could. You see, a lot of people in the subreddit didn't forget about what the hedge funds did in 2008, and they were out for blood. You see, for shorting to actually work, it has to scare the other investors into selling. So if the other investors are buying more and holding, that's how you cause a short squeeze. And this was the beginning of the GameStop movement, with the general consensus being if everybody bought and sold, the hedge funds would be forced to buy back their shares at whatever price we wanted. And mathematically speaking, this was the only time in history where it was actually smart to buy into a bubble. This is because, like I said earlier, the hedges had 140% of the float shorted, meaning that when they had to cover their positions, they would be forced to buy all of the publicly traded shares of GameStop and then some. So that meant that no retail trader would be stuck with the bag, and they could basically demand any price they wanted, at least if it worked out. The key to the plan would be to buy and hold as many shares as possible, which wouldn't allow for the price to drop, meaning that the shorts wouldn't be able to cover their position, they'd be stuck paying interest, and eventually they'd have to close their position for a massive loss. Now, around the time of what I like to call the micro squeeze, which was GameStop's initial run from around $20 to $400, you probably heard mainstream media saying, the fundamentals don't check out. So my question for them is, why weren't they complaining about the fundamentals when GameStop was shorted so low below where it should have been fundamentally valued? They weren't complaining then. I mean, compared to the amount of revenue that they were pulling in and the stock price that they had, they should have been valued at much more than they were. And that's exactly why fundamentals don't matter anymore. The shorts took advantage of the fundamentals. They changed the game. They shorted a stock way more than it should have, and they got caught with their hand in the cookie jar. And that's why, on the upswing, the fundamentals were so messed up. Because this isn't about the fundamentals. This is about somebody having to buy a share back at whatever price it is. That is how shorts work. They have to cover. So mathematically speaking, there is no limit on what price GameStop could hit. To understand mainstream media, you have to understand where they get all of their information. It's not like they're trying to put out all of this misinformation, but when your sources are quite literally the people who benefit off of fraud in this situation, you have to expect some lies. You see, the media doesn't understand today's market, and they need experts to tell them what's going on. I mean, it is pretty complicated with its AI, high-frequency trading, derivatives, and all-around just complex metrics nowadays. I mean, think about 2008. The media always said, the market is great, until suddenly it wasn't. They said, buy Bear Stearns, until it went bankrupt. Oh, and Goldman was solid, until one day it was just gone. I mean, how many times does the retail trader have to be fooled by mainstream media to understand that they don't have their best interests at heart? The only difference between today and 2008 is that the problem back then was mortgage-based securities, and the problem today is naked shorting. And from the way things are turning out right now, they're going in the exact same direction. And my friends, I don't mean to scare you by saying this, but a market crash is 100% imminent. The VIX indicator, which is a volatility index in the market, is going off the charts right now. The repo markets are having their funds drained by people who need them, when normally the funds are in excess. Not only that, but financial regulators are pumping out new legislation that says if one big player in the stock market goes down, it'll limit the damage. Now let's once again relate this all back to the GameStop fiasco. Let's go back to that micro squeeze I was talking about, when it went from that all-time low from when the shorts shorted it up to 500. You might be asking, Ethan, why did the stock go back down after it squoze? Well, there are two reasons for that. Number one being Robinhood's halting of the buying of the stock, and number two is the hedge funds saying that they closed their short positions. You see, just as the squeeze was taking off, Robinhood limited users to only sell their stock, which meant that the price of GameStop was basically at a halt. Now, this didn't mean that it had to come crumbling back down like it did, but it did limit the growth and the potential of the short squeeze. Why would you do this, you may ask? Well, keep in mind that Robinhood is backed by Citadel, so without Citadel, Robinhood wouldn't be able to function. But what this did was scare weak-handed people into thinking, the squeeze is over, causing a mass sell-off, driving the price down to around $40. Now, the second and probably more impactful factor was that shorts announced that they closed their positions. But can we really take their word for it? Let's do a little bit of a deeper dive. The first thing we should look at is GameStop's decline from its peak, which, although it is very steep, on the days that it was dropping, there wasn't much volume. So what that leads a lot of people to believe is that this drop wasn't caused by a mass sell-off, but by actually more shorts piling on their position. Now, what should have happened with GameStop after its quote-unquote squeeze was that it drops all the way back down to around where it was, because that's where it's supposed to be fundamentally priced. But it didn't. And this is super significant because if we use FTDs, which are failure to delivers, and option flows, we can actually see that shorts did not close their position. Contrary to what many popular websites say, like Ortex, which use the self-regulated numbers that are provided by the hedge funds, if you look at the option flow data and the failure to deliver it on the stocks, which are two key indicators of there being synthetic shares in the company, well, it's at an all-time high. Options flow data shows that they didn't actually close their shorts, they just hid them with married puts and synthetic calls. As well as the failure to delivers, which means that somebody bought the stock but they didn't actually have it delivered. Now, failure to delivers happen in every stock because it's a very complicated market with a bunch of liquidity issues going on and a lot of just crazy complicated stuff going on. So you can expect some shares to not, go through with the transaction. But GameStop has one of the highest failure to delivered rates of all time. I don't think we've ever seen anything with this high of a rate of failure to delivered. Now, I know what you're probably thinking, because to the average investor who didn't do the research, this just sounds like a bunch of financial mumbo jumbo. But let me make this clear. We have never seen a stock that has this many failure to delivers, with this much shady activity going on, and with this much money in play. And this is where everything starts to come together, because what it looks like is that Citadel lied about closing their shorts in the hopes that it would cause a flash crash, which it semi-did, but it didn't get low enough to the point where they could close their positions. Once people realized that the stock wasn't dropping anymore like it should, they realized something weird was going on. So the price started to move back up. This was because for the first time in history, the army of retail traders were armed with information that they never had before. They were armed with the information that the hedge funds would be trying to take their stocks away at a super cheap price. So they held on for dear life with those diamond hands. Now, over all of this time, from the time they placed their position in mid-January, through the squeeze, through the drop, and now through another growth period, it looks like, the shorts have been paying interest. And after the price held above 30 for like a week or two when it was hovering in that price range, it looks like the shorts finally started to give up. Because suddenly, the price started to uptick quickly again, and I mean quickly. Now let me just make this clear. There is zero reason for this to happen other than somebody was lying to us. And if somebody's lying to us, there's something to hide. So you may be thinking to yourself, so Ethan, what's next? And this is where my speculation begins. As of the last time it was on the market, it closed at around $250. And when you look at some of the stocks analytics, a lot pops out. The first thing to look at is the beta, which is basically the relationship between the stock and the broader market. Let's say a company has a beta of 1. This company would basically move with the market. It would basically have the exact same patterns because it has a pretty equal relationship with the market. Let's say a company had a beta of 5. The market moves up 2%. This company would go up, but it would go up a lot more of a drastic amount because that beta is a lot higher than 1. So you can see when you increase in a beta number, the drasticity, I don't know if that's a word, drasticity of the movement compared to the market increases. Now, GameStop has a beta of -32. Yes, let me just sit here in silence for a second to let that sink in. -32! That's unheard of! If the market crashes, we are going to become rich as GameStop holders. That is just fact. And the reason for this actually supports our theory about a market crash and about the synthetic shares. Because what that is basically saying is that when the market crashes, it is going to be caused by the hedge fund that holds GameStop. Because they're going to need to liquidate the funds and then buy GameStop shares to cover their position. Meaning that when the market crashes, GameStop is to the moon, baby. Another thing to look at is AMC, another heavily shorted stock. It recently squeezed from around $10 to $60, and while I initially thought it was just a distraction from GameStop, I think that it's really become a beam of hope, and it's also put a lot more money in the apes' pocket so they can buy more GameStop shares. Not to mention the recent flash crypto crash, which a lot of analysts are predicting was a large hedge fund liquidating funds. Sound familiar? It seems like financial regulators also smell the market crash coming because they have been churning out new legislation that if a big player in the stock market collapses, like, a market maker or Citadel, then the entire market wouldn't be affected as much. Well, what's going to happen next then? Well, I'm not a financial advisor or anything of the sorts, but I personally am all in on GameStop with a little bit in AMC. That's because something in the stock market like this is unprecedented. There's so much shady activity going on, I can't see this not going to the moon. But hey, if I'm completely wrong, well then I'm okay going down with the ship and losing all of my money, because at the end of the day, it's about the movement. The most logical conclusion, in my opinion, is a controlled detonation, with Citadel taking complete blame for the entire naked shorting scandal and allowing all of the other crooked players in this situation to walk away scot-free. This makes the most sense because the government gets a shady player out of the stock market, gives its people a mini stimulus, and then BlackRock, the people who set up this whole trap for Citadel because they picked up on their patterns with Toys R Us, is going to be there to pick up the pieces. Reminds me a little bit of 2008, doesn't it? Now remember, I'm just a random Jew on the internet who sourced most of his information from his own research and Reddit degenerates. So do your own due diligence and find out for yourself what you want to do with the GameStop stock. Want to help out with the GameStop movement? Use the referral link down below for Webull for 2 free stocks, and they will never halt trading for GameStop, so make sure you use them over Robinhood. That's gonna be it for today, guys. If you're able to sit through this whole long ass video, which I'm sorry, but I really tried to cut it down. This was the shortest I could possibly make it without cutting out any important information. Make sure you drop the like button down below. And if you really enjoyed, you know, instead of subscribing, go onto Webull, buy a share of GameStop, and hold it. That's what you should do if you really enjoyed. But anyways, guys, I've been Ethan. This has been Think Like a Jew. Have a wonderful day, and go make some damn money.